Welcome to Our 2 Cents on Your Dollar, the podcast brought to you by Strategic Insights, where we break down the numbers, decode the noise, and offer smart takes on money matters so your financial future makes sense. It is with a heavy heart that we need to address some misinformation from the highest office in the land. No tax on Social Security and the one big beautiful bill. That's right, that's misinformation. There is tax on Social Security, and we're going to show you in a little bit how that works. However, there is a nice additional senior deduction of $6,000 per taxpayer for certain individuals less than a certain income threshold that we'll get into in just a second. So,
you forgot above a certain age.
I said senior, right? So we're going to define all those things and all those nuances. Oh. Do y'all feel better? I feel like I got it off my chest. Okay. All right. So no tax on Social Security. Oh, by the way, so I feel like we need to address this because I don't know about you all, but I've already received some calls asking that. And so by the way, this isn't to get political. This is not to throw mud at anybody. This is I feel like some people are going to make Social Security claiming decisions based on the fact that they think that there's no tax on Social Security. Mm-hmm. Mm-hmm. As we discussed, the Social Security Administration sent out an email, a press release to everybody in their database saying there's no tax on Social Security.
Alive and dead. All of them.
That's for another podcast. Okay. Yeah. Well, we really ratcheted it up right there. Okay, so before we do that, why don't we talk about the way Social Security taxation does work? So are Social Security benefits taxable?
Nothing has changed. Okay. And our goal is to clarify and silent the noise because there's a lot of confusion, but nothing has changed with the one big beautiful bill specific to how Social Security is taxed. So the way that works is it's based on what's called your provisional income or combined income. And the way that works, you start with your adjusted gross income, and you add up all of your income and 50% of your Social Security benefits. For example, if you're single, if you file single and your provisional income or combined income is less than $25,000, you don't pay any Social Security taxes. If your combined income is between $25,000 and $34,000, you will have to pay up to 50% of your Social Security benefits will be taxable. If your combined income is more than $34,000 as a single filer, then up to 85% of your Social Security benefit will be taxable. That did not change with the one big beautiful bill. So if you're filing joint and you make more than $44,000, up to 85% of your Social Security benefit will be taxable. Yeah.
Yeah, so let's take a look at a scenario right here with some software that we have. So you're here on the left, you're looking at a married couple, two 65-year-olds, taking $50,000 from their IRA, and that is it. So as you can see down here as I scroll down, this is the tax liability. Okay, so the scenario on the right, all we're doing is adding $50,000 of Social Security benefits. And in theory, if Social Security is not taxable, the tax liability should not change, right?
Correct.
Okay, so let's see. Oh, what do you know? They're not the same. Mm-hmm. Okay, so I know what you're thinking. You might be thinking, well, James, there's something wrong with your software.
Input,
right, operator error. Yeah. Okay, so let's get into it then. What is the new senior tax deduction and how? Well, you know what? What's the saying? With every lie, there's a seed of truth, or something like that.
Yeah,
or
that's what my dad used to say.
Yeah, my dad used to say, right? Or where there's smoke, there's fire, or something, stuff like that, right? So giving people the benefit of the doubt, where did that misinformation come from? The no tax on Social Security.
So it was something presented in the bill originally that passed through the House. But then when it finally received Senate approval, that was removed. And in place of that, to kind of provide something for that demographic, there's a new additional deduction that is provided to individuals age 65 and older.
It's a bonus deduction. So there's already an age 65 deduction of $2,000 for single filers and $1,600 for up to $3,200 for married joint. This is an addition to that. Yeah.
Those numbers changed, right?
Yes, from last year to this year, it went up from 2,000 to 3,200. Yep.
Yeah.
So the new additional bonus deduction is a $6,000 deduction per person. So for a married couple filing jointly, it's an additional $12,000 deduction on top of their standard deduction and on top of that 65 deduction as well too.
I think your favorite lines, is it above the line or below the line, right? And I think that that's one of those things that people need to understand, that it's below the line, right? And so therefore it creates some different options for them. You know, they should not be basing their Social Security decisions just based off of.
Yeah. So just to kind of say it plainly, Social Security taxes did not change, but with the higher deduction, it could reduce your total taxable income, which reduces your taxes, but it's not specific to Social Security.
I'm so glad to hear you say that, Mr. Purveyor of misinformation, propagating it even further. Okay, so what if I'm 62 years old and I'm claiming Social Security? Is it going to be taxable?
Yes.
Okay. And do I have this enhanced deduction to offset it?
Not until you're 65.
Okay.
At the same time, though, this bill is set to expire in 2028.
So that was another thing I was gonna ask. So what if I'm 20? What if it's in 2029? Are my Social Security benefits going to be taxable? And am I going to get this enhanced deduction?
Unknown.
Oh, say more, sir. There's a curveball right there.
I mean, again, not sure what bills will be passed or extended, right? At this point in time, the rules are set to expire in 2028. And so if it makes sense for you to take Social Security, it should not be based just off of this decision alone, right? There should be other impacts, other factors into this.
Yeah, now I understand why you've been saying all along it's been misleading. I mean, because with that example, if you're 62 and you keep hearing that Social Security is no longer taxable,
Take it.
and you take it,
Taken.
it's going to have significant tax ramifications. Yeah.
Listen, I wish I had the stats here, but I mean, I'm sure y'all have had the same experience. But I've had plenty over my career. I've had plenty of people say, "James, when should I file for Social Security?" I said, "Well, do you need the income? No. Okay. How do you feel about taxes? Well, I got this rental income. I'm still working, even though I'm full retirement age. I'm still working. I have rental income. I have business income. I kind of don't want any extra income." Okay, well, then you probably should wait till 70. Well, I'm not going to live that long. Well, I know, but you're going to pay taxes. And I think it's less than 10% actually wait till age 70. So, but I've been lucky enough to be able to convince some people in those situations, in high tax situations, to delay filing. I could see them now, if taxes weren't a thing, I could see them saying,
Sign me up.
Right. Sign me up. I didn't even want to wait till 70 anyway, but you convinced me because it's going to impact my tax situation. Yeah. So that's why I believe this is important.
Right.
Yeah.
When can we start taking this enhanced senior deduction?
Beginning of this year.
Okay. What if I'm 64?
You have to turn 65. So you got to be 65
When?
in the year that for your filing. So for this year, you turn age 65 at some point in time for this year, then you're eligible to receive that deduction.
So 12/31/2025, I turned 65.
You're good.
I can take the deduction.
Take
Right.
it.
Right. No, well, you can still do proactive planning. I was going to say this shorter time frame, but you can start planning now based on that knowledge that if you're 65 and over, you have an additional $6,000 deduction.
Yeah. Well, Mr. Purveyor, I'm going to come back to you.
He's talking about me.
Yeah. What if I make $300,000 married filing joint adjusted gross income? Do I still get this tax deduction?
There's a phase out. Yeah, there's a phase out. If you make less than if you're married filing joint, if you make less than 150,000, you get the full deduction. But there's a phase out of 6%, and so by the time you get to 250, you're completely phased out.
Okay. So this enhanced deduction is meant to take place of the no tax on Social Security, as Leo mentioned.
Right.
But not everybody might even get this tax deduction.
Correct.
So this goes back to his point about planning, right? So there's certain thresholds, right? I believe it's single 75, it's married filing joint 150, right? So I think, and you go back to this planning component of, right? Does it make sense? Do you need the funds, right? And then if you're right around those thresholds, right, you want to make sure that you meet those guidelines to take advantage of this.
Yeah. I think another reason why this conversation is timely is because this year the Social Security Fairness Act was signed. So there's going to be a lot of people. I think the number as of the week ending in July 4th was 273,000 new Social Security applications. Social Security Fairness Act repealed the windfall elimination provision and government pension offset, which reduced Social Security benefits for some folks and even spousal benefits for some. So those people that were impacted are getting lump sum retroactive benefits that will be taxable this year, even though they were based on last year's benefits. And so we don't want them to think that
That's not going to get taxed.
Yeah. Okay, so you mentioned proactive planning. So what are some proactive planning things we can do to take advantage of this enhanced senior deduction?
Well, one, it could be do nothing. If your plan was not to take Social Security because it made sense for your situation, we can't repeat it enough. The taxes for Social Security have not changed. So for your situation, if you were not planning on taking Social Security, stay the same. Don't take it. Wait.
Yeah, another proactive strategy that may be in consideration is utilizing a Roth conversion, right? So in this circumstance, with this additional deduction for these individuals that are eligible, you now have another, married filing jointly, another $12,000 that's being deducted. So you can then take advantage of that and utilize a Roth conversion and convert some pre-tax money into after-tax money. And that deduction would then offset some of the tax liability, depending on the dollar amount that you're converting over into Roth. So it's a good time to be able to do that while you still have that additional deduction.
I think reviewing your additional income other than your income you're currently receiving, right? So looking at tax-free bonds, looking at dividend income, looking at CD income, and making sure that isn't going to negatively impact your eligibility.
Yeah, and if you're just trying to offset some of the increase in income, even things like foundational things like tax loss harvesting, if typically you generate capital gains from your portfolio, might be a little bit difficult right now, but being proactive and looking to see if there's some tax loss harvesting opportunities just to offset some of that income that's coming down. So
Which income are you talking about?
yeah, just in general, if through the Social Security Fairness Act, if you did get a lump sum, if your benefits did increase, because at the end of the day, it's all about total tax. And so your Social Security will be taxable. You have interest, dividends, capital gains. It's just every little thing is going to start to matter. And so if there's an opportunity to at least reduce an income bucket, which in this case would be capital gains, then I would look at things like tax loss harvesting. Every bit can help.
Yeah. Okay, so if you're trying to manage income, would Roth conversion still make sense?
No, in this circumstance, because whatever you're converting over from pre-tax to Roth would be considered ordinary income. So if you're trying to manage that, that wouldn't be a strategy you necessarily want to take.
Should people be trying to manage that?
Yeah, absolutely. There's so many things that are impacted by your AGI, right? And so there's so many different things that you have to look at in consideration. So it's really important, like when we're looking at from a total tax perspective, as Credo mentioned beforehand, understanding what is considered income and what is not considered income. Because at the end of the day, when we look at, how much of your Social Security is being taxed, different things, understanding what your total actual income dollar amount is from a household perspective as well too, right? Considering who's receiving the income and where it's coming from, all that's extremely important in making that determination.
Okay, let me give you, for argument's sake, let me give you all a counterpoint. I shouldn't worry about that.
As an advisor or as a consumer?
Sure. Not as a consumer because I'm not 65, right? But if I was 65,
Right.
nobody's wondering. Nobody's on the edge of their seat on how I made
Oh,
that.
I am.
Yeah. Okay. Good. That's the way I like it.
He really does.
I do. I hope you're on the edge of your seat too.
Yeah.
Okay. So let's say, using hypothetical numbers, let's say I convert $50,000 of my traditional IRA, or I've been doing it for years.
Right.
Okay. And I was okay with the tax impact last year.
Right.
That $50,000 bumped my AGI up to 200.
Mm-hmm.
And I was okay with that tax impact last year.
Mm-hmm.
Yes, I'm not going to get the full $12,000 enhanced senior deduction because my AGI phases me out.
Right.
But I'm still getting a larger deduction than I was last year.
Right.
So my tax liability is actually going to go down.
Down. Right.
So do y'all still stand by what you said? Huh?
It seems like you were comfortable with taking and paying the taxes. There's no reason to change.
Wow.
Okay, good.
Yeah. Yeah.
Point is you got to look at your own specific situation, and it just depends on how you look at it. Are you a glass half full or glass half empty kind of person? So I don't know. Would y'all say that's accurate, or am I off base here?
Again, it goes back to the planning, right? What are they comfortable with, right? If they were comfortable with the taxes before, then and it doesn't change their situation in regards to their lifestyle impact, then they should be comfortable now. If they have a change in heart and want to try to take advantage of these deductions, then we can start working that angle too. So kind of goes back to preference, right? What is it that they are trying to accomplish?
Alexis, thank you. Okay, I think one of the other strategies that we should consider with this new deduction is distribution sequence. Like if you're retired, if you're 65 and you're retired and you're relying on your assets to fund your retirement, I think this new deduction changes where you take, what type of account you take your money from first.
Right.
I think the number is a little over $46,000 with this new, with the new standard deduction, with the increased existing senior deduction,
And the new bonus.
and the new bonus deduction
For joint.
for joint,
Yeah.
married filing joint.
Right.
I think the exact number is $46,700.
Yeah. It's huge.
Yeah, it's a lot of money.
So in theory, you could take $46,000 out of your traditional IRA, if you had no other income,
Right.
out of your traditional IRA and pay no taxes.
No taxes.
Okay.
Yep.
There's also another bucket of money that's subject to 0%. Can y'all talk about that a little bit?
Yeah, long-term capital gains and qualified dividends. Married filing joint. Married filing joint, you can have those up to $96,000 and pay no capital gains tax. So for single, it's you can have those up to $48,000 and not pay taxes on those.
And that's taxable income, which is after deductions.
Yes.
Right.
Right.
Yeah.
Yeah.
After deduction.
So
After.
So if you added 96 to 46,
Right.
that's what, 142.
Yes.
So if you could have $46,000 from your traditional IRA,
Right.
$96,000 of capital gains and
gains.
qualified dividends,
Right.
and pay zero taxes.
Right.
Yeah.
It's amazing what planning does.
Yeah.
Yeah.
Hey guys, is that good for the country? Sorry, different podcast, right? Sorry.
I was gonna say, not to Credo's point.
Is that Advisor Alpha? Sorry, that's another podcast too.
I mean, understanding the tax treatment and how to receive your income is so important. And taking advantage of this is an opportunity in the sense that, yes, there is still tax on Social Security, right? And they are trying to provide a caveat to offset not being able to provide something like that. But understanding what the rules of the land are now and strategically thinking through that and making sure that we can fully take advantage of what the opportunity is. I think at the end of the day, that's where we have to sit here and think, okay, here's what the rules are now. How can we go about utilizing what we have at our disposal and taking full advantage of what that is for the time being? And so, strategies like that when it comes to, capital gains, long-term capital gains and ordinary dividends, and utilizing the deductions appropriately. Yeah, I mean that's a significant amount of income annually and paying nothing in tax.
I think asset allocation and mental accounting are two big things here, right? Making sure that they understand how and where these things are positioned and how it impacts all their benefits and their deductions.
Yeah.
How are we gonna pay off this debt? Just suck. That was my only political.
Well, I'm glad you did that because I was going to wrap it up, and then I realized maybe you should clarify a couple things. I don't want to sound critical if there's no tax on Social Security. Actually, me personally, personal opinion here, I think that is the right thing because oftentimes, should I keep going with this?
Oh, absolutely.
Okay.
Yeah.
It's not off topic?
No, it's okay.
Okay.
No.
I think it's worth clarifying because I've had this debate with clients over the last few years. People will say, why do I have to pay taxes on my Social Security benefits twice? And so I remind them that you didn't.
Yes.
That your employer paid half into it that you never paid taxes on.
Yeah.
Furthermore, a portion of the income taxes goes to the Social Security Trust Fund that pays for benefits. So if you were to cut out tax on Social Securities, that's just going to make the Social Security Trust Fund run out quicker.
I always used to tell people when I first got started, I think the limit was like 116,000. And so I would tell them, right, if you make over that, you give yourself a 6.2% raise. As that years have gone by, that number has continuously increased. And I think this is a big conversation. Well, I'm going to take Social Security because it's going to run out of money. And so as you start looking at how they've changed that to make sure it does not become insolvent, I think the number is up to 176. It's 168
I think
last
it's like
year.
one in the 70s for.
I want to say it was 168 or something like that last year, and it's up into the 170s this year, right? So they continuously keep increasing, and they're going to continue to do so to make sure.
Yeah, it's one of those things that they're gonna have to pull a lever to continue to keep the trust funded, and it's whether you pay tax and then there's there's thresholds of how much you pay tax wise, or it's you can't get it until a much later age, or it's you have to you're gonna pay into Social Security at larger wages. There's other things that would have to go into effect to continue to keep it funded, right? And so if we took that away, like you said, then the probability is, especially now with how many more individuals are now taking Social Security and eligible to take Social Security.
I had a client in earlier today, and they were making comments. The spouse is old. One spouse is older than the other, and she was like, "Well, you got to wait actually longer than I did."
Sure.
It's funny is because we have the saying, "Don't let the tax tail wag the dog." In this case, I want to say, "Don't let the political tail wag the tax dog."
We're like dogs in our practice.
Yeah, we do.
Yeah.
What I mean by that is whether or not, I don't want this to be a political conversation, whether or not you support the one big beautiful bill or not, there are some tax provisions in there, and we probably should take advantage of them. Whether or not you believe in it or support it, or
It is what it is.
It is what it is. Here it is.
These are the rules. This is how we're going to play.
Yeah, it's true. Americans, whether you believe it or not, if it makes sense for you, do it.
Right. Yeah. So this is not a critique on anything. This is we just want to clarify some potentially misinformation.
Let's stay capitalists.
Anything else anybody should consider with regards to the enhanced senior deduction? I believe that's what it's called, right?
Yeah, sure.
Yeah, sure.
I think it's called just a bonus deduction. I don't know if it's enhanced or bonus.
I mean, I think the actual text says...
enhanced. Gotcha.
No, it might not says... I think it says additional senior deduction.
On the actual...
On the bill.
On the bill.
Yeah. Before we wrap up, I want to go back to something you said. Earlier, James mentioned that if you're single... It might have been Alexis. I don't know. Anyway, James or Alexis. If you're single and you make more than $75,000, your additional senior deduction is reduced. and I think it's by 6% for every $1,000 over that income threshold. It's $150 for married filing joint. The top of the range where you're completely phased out for the deduction is $175 single and $250 married filing joint. Okay, but what counts as adjusted gross income? It's actually modified adjusted gross income, which I believe includes people that are impacted by Internal Revenue Code section 911, 931, and 933, I believe, which is all basically foreign income.
To reiterate, there are no changes regarding taxation on Social Security. So none of that has changed. So don't make any decisions based on some headlines that you may have seen regarding that. What did go into effect are these new deductions for individuals that qualify. So, at the end of the day, the best thing for you may be, like Credo mentioned earlier, is do nothing because nothing changed regarding Social Security being taxed. So just keep that in mind. That's what actually happened.
I was gonna say the taxation was the same before the bill as it is after.
With regards to Social Security, yes.
Yes.
Yep.
Yeah. So actionable takeaways, review your distribution sequence, consider a Roth conversion, consider how a Roth conversion could potentially phase you out of the deduction.
Right.
Might be worth revisiting your Social Security claiming strategy, even though the result might be do nothing.
Right.
But it might be worth
Might be worth
Right.
it.
Yeah. And be careful what you're reading when it comes to this, right?
Yes.
Yeah.
Yes.
Okay.
All right.
Thank you for joining us on Our 2 Cents on Your Dollar, proudly presented by Strategic Insights. If today's conversation brought you clarity, please pass it along and don't forget to subscribe, share, and check the description below to learn more about us. Until next time, stay informed, stay invested, and stay strategic.